Hi everyone, it's the Catholic CEO, Henry Kutarna. Welcome to this Catholic Business Wisdom Series topic today on the banking system and how to deal with the banking system. Four main categories today. One is a recap of money and the banking system, just a little bit of a summary. And secondly, some information for business owners about dealing with the banking system. Third, some actual strategies for dealing with the bank successfully, and then closing finally, number 4, with some cautionary notes, some cautionary tales. Let's begin with, first of all, a recap of important topics in the banking system. First of all, it's a fiat money system that we have. So it's a system that is based on our belief that the currency in any particular country does represent a store of value and a medium of exchange, and that holding those currencies like the US dollar or the Canadian dollar or the euro are actually a sign and a guarantee that you own that amount of money and that you can use that money for anything, such as purchasing goods and services or saving or investing in something. So it's not a gold standard anymore. There was a gold standard in use for many decades where the currency was tied to the volume and quantity of gold as well as the price of gold. Now we have a fiat money system. It's a floating exchange rate where countries back and forth have varying exchange rates between their currencies depending on their balance of trade and exports and that sort of thing. We've talked about that in great detail in the past. Money is created today through debt. You cannot invent money unless you take on debt. So you go to the bank, for example, you borrow $100,000 to buy some equipment, let's say, or for an investment, and that money is created out of thin air, so to speak. It's an entry in the bookkeeping system. It's tied to various relationships with the central bank of the country, governed by monetary policy, where the government can ease or restrict the flow of capital into the money system. The interest rate is the price of money, and it is also tied to the debt system in the banks. We have a fractional reserve system in the sense that, let's say, a bank has $1 million in its deposits ledgers, then that bank can lend out multiples of that amount. And so it might be $6 or $7 or $8 million if that bank has a capitalization of 1 million. And the reason for that, or the logic behind it, is that you can believe that you can lend out that money and there'll never be a call from consumers or debtors to take their money out. And so banks have learned that you can, not only have banks learned, but the governments have approved the principle that you can lend out multiples of the money, knowing and believing that you'll never have a run on the bank and people will not come and seek their money all at once. And so there's a certain call for money. People cash in every day, they take their money out, they want it in cash, or they want to buy an investment or do something with it, and so they take money out of their account. That's a simple story of the fiat money system. The dangers of the fiat money system are that it's susceptible to inflation. Governments print money. Like during the pandemic times, governments simply printed money and they paid people to stay at home, and they did all sorts of payments to consumers, to organizations, to not-for-profits, to governments, to businesses. And that has led to inflationary pressures. We're living through that right now. There is the Catholic doctrine of usury, which is a complicated topic. We're not going to discuss it today, but we will in the future have a discussion about usury. There are the growth of digital currencies now, and one of the advantages of a digital currency is that it is free from government control and monetary policy. It exists only because people believe that it's a medium of exchange, and it exists because it's, transferable. You can take your digital currency, let's say your Bitcoin, and you can exchange it for what you would call real dollars. you can do that exchange and it's legitimately permitted. And that's why digital currencies are popular, because they are, in a certain way, less traceable. It's not that they're untraceable, and they use a blockchain system of guaranteeing their validity and that every transaction is tracked and that every system that uses it is regulated in the sense by the blockchain system, but not by the laws of nations or by monetary policy. So that's a little recap of the money system, and that's a semester of MBA work right there in a few minutes. But it's an important topic because you are going to encounter the banking system and the money system at every level of your business. Let's take a look now at the second major topic about the business, how you will interact with the banking system. First of all, you might have in the bank, your local bank, a checking account. You'll be able to write checks or transfer money using an e-transfer method or any other of the payment systems out there from your checking account to pay for your obligations, like paying your bills and buying things, goods and services, and doing other things that you do with your currency, such as payroll and your obligations, tax payments, and other taxes and charges and fees. You may also have a savings account, and where a checking account might have a very low rate of interest or no rate of interest that you earn, you will have in a savings account a somewhat higher rate of interest. And so the idea is that if you park that currency in the savings account, you can earn a higher rate of interest because it's easier for the banking system to lend it out using that fractional reserve system that we've talked about recently. You might have a line of credit, which is a promise from the bank that you can write a check and use money. It's also, as we say, created out of thin air because it doesn't exist until you write that check to use it. And so you could have a line of credit. Usually a line of credit there's rules and there's fine print. Of course, you're signing a contract. But in a line of credit, you're going to be paying off debt. You're going to be using it to pay payroll, to smooth out the irregularities and the peaks and valleys of how you take in your revenues and how your customers pay you. A line of credit will charge you a rate of interest, and you really should be in your business operating on the assumption that you pay off your line of credit every month by the fact that revenue has come in. You use that to pay down the line of credit, which you might have had to spend a few days earlier. A common example, you want to make payroll on the 31st, and so you write a check from your line of credit, or you pay people from your line of credit directly by e-transfer or by checks or direct deposit, and then on the 4th or the 5th, when sales revenue comes in, you take those dollars and you pay off your line of credit. That's the ideal system. The great danger, of course, is that you could create a balance on your line of credit and you could max it out, maximize the line of credit, and therefore have no room to maneuver. And a lot of companies get into trouble in this way. So you will want to guard carefully against that. You also may have in your business term loans or collateral loans. You might be buying a piece of equipment. You might be buying a building. You might be buying or leasing vehicles. And so you might obtain a term loan. Once again, it's a contract. Money is created through this form of debt. And once it's created, you, of course, are obligated according to the terms of your contract, to pay it off, to pay interest on it because it's borrowed, and to reduce your obligations on a regular basis, monthly, weekly, quarterly, whatever the rules are according to your contract. There are also what I call government-owned or near banks. The Economics 101 term is near banks, and these would be SBA loans in the United States, the BDC, the Business Development Bank of Canada. There might be community futures organizations that lend money to you. And I call these near banks because they are usually not-for-profits or government-controlled or community-controlled. And they are also part of your banking system because they do make available credit and grants and money and loans to you, often under more favorable conditions because they're many times focused on helping small business startups or early stage companies. Remember that when you deal with the banking system, there's a term to your loan, so you'll have X number of years to pay that loan back on a monthly basis with interest. And remember to do the analysis when you add up the interest paid on a loan versus paying the loan off quickly, or versus using your own funds or borrowing perhaps privately. The terms of loans are very clear, and you will be, I suppose, surprised to see how much interest you're actually paying, even at nominal rates of interest like 6%, 8%, or whatever you're getting. There's a common expression when you have a loan, my loan is at prime plus 1, prime plus 2. So the prime rate of interest, which is the interest rate for that day or that week set by the central bank, and that is the rate that you'll get, and the most credit-worthy customers will get the prime plus 1 designation. Sometimes, although rare, you can get a loan at prime, but that's only if you're a superb customer with a sterling record and probably a large cash flow, perhaps bigger than most small businesses. You also have services in the banking system. So if you want to do FX transactions, that is foreign exchange transactions, where you're buying, let's say, US dollars to pay obligations, or you're receiving funds in US dollars and you want to convert it to euros or Canadian dollars or Australian dollars or other currencies. You can do wiring and of money and transferring of money. You can do global money transfers. There's all types of services that banking system offers you, including credit card transactions, debit card transactions, and all other manner of financial transactions. So that's how you're going to encounter the banking system. This would be familiar to most of you. The only note that I would add there is that you should be careful to understand the consequences of anything you get yourself into in the banking system, which then leads me to the third category of discussion today, bank relationship strategies. I always urge you to shop around. You should every year, perhaps twice a year, shop around to other banks to see what they're offering by way of interest rates, bank charges, service charges, convenience, ease of operation, time period. If you get money in and you get revenue, sometimes there's a hold period, 24, 72, 48 hours. Sometimes it's long, and sometimes you don't have access to your capital. Sometimes if you want to take money out, you will have a hold period, or a period of, it's not a cooling off period exactly, but it's a period of time between your decision and the actual transaction occurring. So you need to shop around, compare notes, decide who's going to offer you better services, and also determine the kind of relationship that you're going to have with the bank. It's important to actually meet your bank manager, even though they're very busy and they have far more accounts than they can actually humanly deal with. But it's important to try to have a relationship. There's that old joke that you've heard me say before. An old friend of ours who was a vice president of a large Canadian bank used to say, I never go into a bank and form a relationship with anybody that doesn't have walls to the ceiling and a door to their office. Anybody that has a cubicle or walls that don't go to the ceiling, I do not form a relationship with that person, because they will never, be able to do anything for me. They'll never have any discretionary authority. A bank relationship strategy includes your credit card usage. Credit cards sometimes are without a fee. Sometimes there's a couple $100 a year that you have to pay in a fee. There's all sorts of, I call them gimmicks, free money, points, airline points, bonus points, gift, access to gift catalogs and that sort of thing. These are simply ways to build loyalty, and they're loyalty programs, pure and simple. They actually add to the cost of your transaction. They are built into the interest rate in your service fee structure. As you know, they're not free, and there's no possible way they could be free. But for some reason, consumers are really interested in these things. And in fact, it's really, if you look at it, it's a silly proposition to do it, but we all do it. And I myself have had company credit cards where I get airline points, and I take the free flight, and I think that I'm getting something for free, maybe, but I'm not. With your bank, another relationship strategy is to develop an annual report. Simple, could be 1 page. Submit it to your bank. Visit your bank manager at least once a year and attempt to form a personal relationship with them. The trouble with the banks is that they change their people considerably all the time. There's a rapid turnover, there's a rapid rotation among bank staff. And so your main strategies then, in summary, are to shop around and compare, to read the fine print and know the consequences of every document you sign and every type of usage that you're involved in. Manage your credit cards and lines of credit responsibly so that you pay them down and keep that debt manageable. Watch it carefully. Watch it like a hawk, because it creeps up and you can max out your credit card, you can max out your line of credit suddenly, and then you've got trouble because it reduces or eliminates flexibility. And don't forget the annual report and the visit to the bank and forming relationships in as best a way as you possibly can for your business. So my fourth category today, the main cautions that I would offer you about engaging with the banking system, which is pretty well necessary. It's almost impossible to operate in a barter system or in a cashless system if you have a business. The banking system is an essential tool, but it's fraught with risk. You need to be very cautious about it. It's not private. It's not confidential. There is monitoring. There is a transactional review that goes on. Some of it is legit to prevent money laundering and other fraudulent activities, but also to monitor you and the growth of some of the future fears like the central bank digital currencies or other methods of monitoring transactions, digital, cards and passports and these type of topics, which are very popular topics these days. These are all the elements of risk that I'm speaking about. So it's an essential tool, but you have to be careful, you have to be cautious, and you have to be knowledgeable and forewarned about the possible. Another caution is to analyze your consequences each time. So if you have a line of credit, if you have a credit card, if you have a term loan, if you're using bank services, always be aware of the consequences. What happens, for example, you take out a loan or a line of credit, what happens if you default? What's the risk? Can you buy insurance, for example, to reduce the risk of defaulting? Let's say your business turns bad and you can't make your debt payments. Are there insurance schemes? Is there a life insurance that you suddenly die and your family or your business partners are left with huge debts and business challenges, and you're not around to help? Is there an insurance policy that you could buy to have what we call key man insurance, key individual insurance, key executive insurance? These are the consequences of your actions, and so the caution is to be aware of these things. Certainly, you'll want to eliminate debt as fast as possible. There's no doubt that the proliferation of interest charges is a drag on your business. It's something that, you may have to buy that tractor, that, trenching machine, that packaging machine, all these things. Yes, you may have to borrow. If you can pay them from cash flow, it's even better. Or if you can make private arrangements, it's even better. But the thing is, if you have to engage the banking system, and for the most part you will, you need to eliminate that debt as fast as possible. Stay on top of it. Be aware in your analysis, the spreadsheet analysis, what is the interest portion and what is the principal repayment portion. You've heard many people say, for example, with a mortgage, that the interest on the mortgage is stacked heavily to the first 7 years of the mortgage. It's not equally balanced among the 25 years of a mortgage. I call it a trick of the banking system. It's the interest package. If you ever see a principal plus interest report monthly for the 25-year period, you'll notice that the interest rate, the charge, is stacked heavily to those first 5, 7, 9 years of the mortgage. And that's a reality. You cannot negotiate against that. There's no possible way, unless you have 8 or 9 figure income, that you're going to be able to deal with that. But the idea then is to pay debt off as quickly as possible, and the highest and best use of excess cash is often not to pay dividends to the shareholders or even to invest in the business, but to pay down debt. The debt-free company, the debt-reduced company, that company that has the lowest debt to income or to asset equity ratio, is the more powerful and the stronger. And so, we could do a whole treatise, and we will, on accounting ratios. But the thing is, if you can pay down debt as fast as possible and try to eliminate it, you're operating in a very intelligent and smart business manner. So debt has to be used cautiously. I always propose that you balance and analyze your debt and equity pictures and the savings strategy that you might have. You might need to extract and slice off from revenue and even from profit a savings program for the rainy day fund for your business, an emergency fund in case your credit line is maxed out and you have to do something besides meet payroll. It's always important to make decisions based on a strategic approach. So if you're a small business owner, you're usually going to be busy, you're going to be trapped into the day-to-day activities, and you may not be thinking about things like savings for an emergency or preparing for an emergency. And so we need to do that. We need to have a micro kind of operational, tactical level brain in our head, but we also need to step back, detach, extract, go to the 50,000, 100,000 foot level and see the trajectory of your business. Where is it going? What are you doing? What does it look like? And then decide there to solve the problems by making certain clever moves that are helpful and that actually solve the problem. So there you have a very brief review of the banking system. The short version is that you're going to engage with the banking system almost inevitably. You can do it responsibly, you can do it carefully, but you have to keep your eyes wide open, and you need to be paying down debt as quickly as possible and understand interest. Understand simple interest, understand compound interest, understand the compounding factor, compounded annually, compounded semi-annually. Look these up. There's great information online. You need to know very much about the interest rate and the possibility that you could be in trouble because of the inability to understand this. I'll say one last thing. Really, it's a relationship to usury as a topic. The credit card system is capped. I don't think you'll see credit cards any more than about 25 or 27% interest. Usually they're 18, 19, 20% interest. But the threshold of usury, where the inability, if you only make a minimum payment at 29%, you will never pay off that credit card. That's a usury topic, which we will get into in the future, but just remember that, the danger. If your interest rate is somewhere in that 27, 28, 29%, and there are factoring loans and there are credit cards that get you into that range, particularly if your credit worthiness, your score is low or troubling, then you're going to be perhaps trapped into this thing. And so the old lesson about paying off the minimum only, it's a lesson that we are all conscious of. We have to avoid that as much as possible. But remember, if you get into that 27, 28, 29% area and you only pay the minimum payment, you will never pay off that loan. It will never be able to be paid off. And so there's a lesson there. There's cautions there, and we need to be careful about that. So there you go. It's the Catholic CEO, Henry Kutarna. Thanks for joining me for this banking system topic today, and I'll see you next time. God bless.